Friends, in this video for iThought Advisor, I'm going to talk to you on the topic lump sum and SIP. It takes two to tango. Usually, investors have this very important question. Should I do SIP alone? Would that be sufficient? Or should I only be doing lump sums? The mutual fund industry has overplayed the role of SIP and also given critics a very powerful handle to question the efficacy of SIP. This is a marketing problem really. It's not an investment problem. When you try to project the SIP as the solution to all the investment expectations of an individual, when it fails to meet those expectations under certain circumstances, people tend to question whether SIP is useful at all. I even saw this very unusual outburst by an investor who is an academic that SIP doesn't give compounding and such arguments. Effectively, investment is something which you do to a strategy, and that strategy cannot be as simplistic as saying that just put money every month and you're going to win. So in that sense, saying that SIP is the only way to succeed in investing is a bit of a stretch. Now to the other side, most investors who do lump sum investing don't want to do SIP investing. They don't want to invest when the markets are high. They only want to invest when the markets are low, and they want to make big investments. But in reality, do people succeed making those fat pitches? That's a questionable thing, because when the market is down, people start thinking that it will go further down. So you know that the market bottom has passed only after the event. You don't know it. You don't know when the market bottom will come before the event. So most of the people who say that lump sum is what suits them tend to miss out the opportunities to make the lump sums. Both these approaches have one common problem, that is expecting perfection out of either. Both approaches are only optimal approaches. In the absence of a better idea, people try both these approaches. But how about following an investment approach which combines the two? That is something I feel is a more realistic and a more working and productive way of investing. That, I believe, will lead to investment success. The SIP can be scoring regularly. It's a run a ball strategy. But if you want to raise the run rate, if you want to make bigger scores in a shorter period of time, you need to make a few investments when the chips are down. And those investments will give you the clear investment differential. The performance comes from those lump sums which you do when the chips are down. The fear that what if things get even cheaper should not stop you from making those lump sums. Size those lump sums in such a way that you can do several of them continuously as your preferred investment becomes cheaper and cheaper. If you had done that last year, as the markets kept falling, for some time you would have looked somewhat silly in the eyes of others. People would have thought that you rushed in to invest. But if you look at the same decisions which you took now, in retrospective, you look like a genius, right? So, to look like a genius in the long term, you need to look a little bit silly in the near term. And you need to accept the imperfections of both the SIP approach and the lump sum approach. And at the same time, recognize that when you mix and combine those two approaches, you may actually get a more positive and a more tangible result. And those results will be something which you like. So in that sense, the two combine very well. It takes two to tango. And as an investor, you should learn to mix the two approaches, blend them together to create a winning investment strategy. Thank you for watching this video.